Welcome to the Grizzle Uranium and Battery Metals Roundtable. We've clearly entered a new era of power utilization and consumption that has underscored the significant value of energy metals.
That's why we're bringing you the Grizzle Uranium and Battery Metals Roundtable. We put together top consultants and management teams to help you pinpoint the key investment opportunities across copper, lithium, uranium, and a bunch of other critical battery metals. Now, before we get into things, we have to thank our sponsors. First is Denison Mines. They're a key North American uranium supplier now and in the future. Next is Power Nickel, North America's most promising polymetallic discovery. Ecora Resources, offering a diversified critical metals royalty portfolio with dividend yield on top. Hot Chili, developing one of the world's largest copper projects. And last but not least, Bid Ask Newsletter, deep dive analysis you won't find anywhere else on the 3 trillion ETF industry. Visit bid-ask.io to learn more. Now let's get into the topics. We're going to be talking about uranium in focus with Denison Mines, Anfield Energy, and consultancy UXC. Next is the value of diversified critical metals. That's with Power Nickel and Ecora Resources. Then we're going to be talking about lithium. Is the bottom in with Lithium Royalty Corp? Copper, robust demand and tight supply. A conversation with Amerigo Resources and Hot Chili, 2 companies in the heart of copper country, Chile. And lastly, a critical analysis of the uranium ETFs on the market with Bid Ask.
We got a big set of topics for uranium. I'm going to cover the key ones for each of the speakers. David Cates will cover topics including uranium reshoring opportunity. Will SMRs be ready for prime time? Denison production outlook and key catalysts ahead for the company. Corey Diaz will cover topics including the strategic importance of uranium in America, uranium market stability without Russian exports, and also uranium milling in demand. 2 of the 3 assets have been acquired. And Nick Carter will cover topics including inventory outlook and potential bottlenecks and America's role in uranium supply. Enjoy. Is this more than a uranium inventory restocking cycle?
Well, in the uranium market, data is sometimes hard to come by. So we are using a variety of like proprietary price reporting reports. We're using things from UXC, which is one of the most well-known price reporters, as well as Trade Tech. They model out demand, they model out supply. And in uranium, like demand is a pretty predictable thing. Nuclear power plants run 24/7, except for planned shutdowns. They run for long lives, 50, 60 years. And the consumption of uranium is pretty predictable. So generally, the fact that we have a nuclear fleet that exists and is operating gives us already this major chunk of very reliable data around demand. And then the price reporters try to do their best to approximate sort of the ups and downs from there. Now, I would say that in the early 2000s, we saw an inventory build more than a restock because, we saw the ramp up of China. And so China went from basically having almost no nuclear program to ramping up to be what will become, the world's largest nuclear program. So there was an inventory build associated with that. What we're seeing right now, I think is a restocking because of years of sort of under procurement. And the challenge that we have is that the supply side is maybe not as reliable as the demand side. And at the same time, we aren't really seeing the best, or most reliable estimates for growth in our nuclear sort of uranium demand profiling from the price reporters. They are struggling to really reflect where demand can go. They're very good at estimating how existing reactors will perform. Right now, they're seeming to be very uneasy, unsure, or very challenging for them to estimate actual growth. So, I've got a pretty high level of confidence around the demand because of the reactors that are there. And I think there's definitely a bias to the upside from most of the market estimates because they're struggling and mostly opting to be conservative rather than aggressive on demand growth.
the uranium reshoring opportunity?
Look, I think we're seeing that happen in a variety of ways. The utilities are already in a way like self-sanctioning from Russia and whatnot, but it's bigger than Russia. What we're seeing from the Western utilities, they really care about risk, right? Like running a nuclear power plant. There's lots of controls and processes and all that stuff around it to make sure it's run efficiently and safely. Part of that is, where do you get your uranium from? Because one of your biggest risks with a nuclear power plant is that somehow you don't have fuel. There's not a substitute for the uranium, and then all of a sudden this capital you've put out, $1 billion plus, is not able to produce electricity and generate your return. So utilities are focused on risk management a lot of the time. And so the reshoring, or the sort of focusing their supply chain to more friendly or Western sources, that's something they're doing naturally because of greater concern around Russia, but also around the influence Russia and China may have on Kazakhstan. Kazakhstan is the largest source of uranium supply globally. For utilities in the United States or Europe, that's something that they're increasingly concerned about. So there has been a natural self-sanctioning that's been going on, where utilities are trying to procure from more Western-friendly sources of supply. The challenge they have is that we don't have that many suppliers in our industry that are from the West. They can only buy so much from Cameco. Like, Cameco is a very credible, reliable supplier for them. But another risk they have is this idea of over-concentration with one supplier. Well, they're already at the max with Cameco. Cameco's got a few producing assets. One of their biggest is in Kazakhstan, so that's a little bit tricky for the utilities to manage. And now they're looking at, well, where else can we get this production from in the United States or Canada? They'd love to get it from Canada. Other than Cameco and Orano, there aren't sources of supply currently available. You need a Denison or a NexGen to build a new mine. And then in the United States, while we have many players that are trying to restart or get production, I guess, back up and running in some of these U.S. jurisdictions, the scale is very small. And so that's a major issue for them. So I think there's a great interest in this reshoring or North Americanizing or Westernizing the supply chain. But I also think there's a major barrier to it, and that's around where those additional sources of supply will actually come from.
When will SMRs be ready for prime time?
Look, I think SMRs, or small modular reactor, demand is closer than people think. That's the short version of the answer. In Ontario, Canada, here we're already building SMRs. So OPG, Ontario Power Generation, has already commenced and advanced site preparation for what will be the first SMR in like the G7, G8 at the Darlington site. And that's planned to be one of 4. They're targeting that reactor, the first one, to be online in like 2028, 2029. Of course, the demand for that starts to impact the market beforehand, because they need it to have fuel and go through the entire fuel cycle before they actually start generating power. So look, I think they are at the front of the curve. So it's a relevant data point, but they're talking about putting 4 there in a handful of years to follow. So if we start to see this pattern repeated by other utilities, and there's no reason that it shouldn't be, because OPG is already a nuclear operator, very credible global utility. That demand could easily be an early 2030s wave for SMRs. Interestingly, the technology is also less far out than people think. Now, we've got SMRs, which are sort of grid scale. Then you've got micro reactors, which are more like remote location, replace diesel genset sort of things. It's the SMRs that are relying largely on existing technologies. And that's why I think you're going to see the uptake of these go so quickly. And it's not just going to be utilities. It's also, Thomas, we're seeing all the AI players that are turning to this. We've seen, Microsoft going large scale reactors, but you could see Amazon's, Google's, even, the one that really impresses me is Dow. Dow Chemicals is citing X-Energy SMR reactors in Florida to support chemical processing. And one of the cool things, this is a quick sidebar here on the SMRs, is it's not just power. They make heat. And so you have industrial applications where they really are using energy to make heat. Well, the reactor is going to make heat in addition to power. And so for things like Dow, this is a potentially huge opportunity on cost, but also on footprint. But look, I think these SMRs are further along than people realize. And I'll just lean on this OPG example. So they're using GE Hitachi technology. This is using basically the back end of a gas power plant. Turbines, power generation, and distribution. That's basically the back end of an existing power plant that would run on a front end of gas. What they're doing is they're sizing now the nuclear to match that back end. And so instead of having a turbine that's unique to one reactor in the world because it's been perfectly engineered by the very smart nuclear engineers out there, they're matching the front end of the nuclear side to match existing components, which means we can actually get into that factory fabrication, economies of scale, all the things that really make a lot of the other power generation sources more affordable or more cost reliable. Now we've got nuclear lined up for that. So I actually think these SMRs are totally underappreciated in the market and in the demand forecasts, and that they're much closer than people realize. Sometimes it takes being close to one to appreciate that. So like here in Toronto, we're going to get that power from that Darlington SMR and the cluster of 4, and we're going to use it. In other parts of the world, they're talking about technology, this and that, and it creates a perception that like, oh, we're so far out on these SMRs because we can't figure out what technology we want. Look, guys, that's what's happening in country like C, D, E, whatever. In country A, B, and the rest of them, like we're already picked the reactor, we're already building the reactor. It's going to come faster than people think.
AI's impact on nuclear demand?
Well, look, I think the AI story, I've been in this business now like 16 years in the uranium business, and AI is just realizing what a lot of us have known for a long time, which is that we've got clean, reliable, cost-effective energy in nuclear. I think the AI story was kind of it's like a head fake earlier this year, turn the other way and then back towards the direction. So that's like a pretty slick move where you fake the guys out this way and then you go and then you're back. But everyone was talking about AI earlier this year and the nuclear piece. And I think the AI story lost a bit of sizzle generally. And then that had some blowback into nuclear and uranium. But realistically, it's not just AI. It's all data processing. And we could have talked about blockchain and this and that. It doesn't matter. Like data processing is not going to become scarce. Data processing is increasing. Data processing, computer power, whatever it's from, increasing. Energy demands increasing. Like Microsoft is bringing back a conventional reactor at 3 Mile Island. That's the scale of that is enormous. But that's just speaking to the amount of power they're going to need. What I think is really, this is maybe a little off on this question, but what's really interesting is that you got the actual technology companies saying, look, we can't rely on the grid. We can't rely on the utilities. We got to go buy our own power. And that's where I think the SMR piece gets tied in a little bit slicker than people might think, because building a conventional large-scale reactor, this is a utility business, right? That's the kind of thing that utilities should run. Even the sort of grid-scale SMRs, utility. But when we go into microreactors, these are things that are being designed for the consumer to operate. Now, the model's not all sorted out for that, but when you've got industry going straight to power generation like this, that's because they need a lot of power. And the nuclear power plants provide big scale on large scale. They can be clustered in SMRs. They can be sited all sorts of places. But most importantly, for a lot of them, they're clean, they're reliable. They'll run all day, just like the data centers will run all day. So they're a really natural fit.
Denison production outlook.
Well, Denison's a uranium miner, developer, and explorer focused in the Athabasca Basin region of northern Saskatchewan. We have quite a long history as a company. We celebrated 70 years in uranium exploration and mining this year in 2024. But right now our focus is on bringing our flagship Wheeler River project through the permitting and development stage and into production. And we're targeting first production in the sort of time frame of late 2027 and into 2028. So it definitely positions us very well for the uranium market that we're expecting. But in the near term, we are expecting actually to return to production first from our McLean Lake project that we own together with the large French state-owned company Orano. So McLean Lake is well known for its large existing uranium mill, a processing plant. Runs 24 million pounds a year. It's licensed to run 24 million pounds a year, so make it one of the largest plants in the world. Processes high-grade ore without dilution, really unique. But the plant was originally built for the McLean Lake mines, and we have had production curtailed there through the sort of down trough of the uranium market. And we are now starting a program in 2024 to basically bring production back online, with production starting in 2025. And so that'll be Denison's first production. Not a huge quantity, but still meaningful as we head towards full-scale construction and production from Wheeler River. So just for scale, we'll probably produce from McLean Lake altogether somewhere in the range of 3 to 5 million pounds over the next 5-6 years. Our share of that's about 22.5%. And then with Phoenix, which is our ISR project at Wheeler River, we're looking to produce in the range of 9 million pounds a year for about the first 5 years of operation, and then more in the range of 3 to 5 million pounds for the second sort of 5-year period of operation there. So that'll make us one of a really strong intermediate producer in the space, with Phoenix being probably one of the largest ISR uranium mines in the world when it's in operation.
Acquisitions on the horizon.
The company's 70-year history, we have operated in multiple jurisdictions. Denison used to be an operator in the United States. We used to own the White Mesa Mill and a variety of mines in Colorado, Utah, and Arizona. In sort of post-Fukushima, we made the decision to divest from those assets, understanding that we would probably go through a long negative period for the market to find itself. And there was high costs there. So we sold the U.S. assets to Energy Fuels. We also had assets in Mongolia and in Africa, all of which we've divested. So, look, we struggled even during good times with some of those assets. And that was just the nature of cost and grade. And so, my 16-year history in the company, I saw some of those not so great years. Even though the markets were up, we still had a hard time actually generating meaningful cash flow from some of those assets, and some of them never got developed. So we certainly switched our strategy to focus on the Athabasca Basin with a very clear idea that we wanted to build a company that would be able to be durable and sustainable no matter the market. We have a very bullish view on the uranium market, but we like the idea of having best in class, top tier assets that are in the bottom quartile of the cost curve. These make for a business that can endure ups and downs in the market. And we think Canada is the place to do that. The Athabasca Basin has got high grades. It has excellent existing infrastructure, particularly in the eastern Athabasca Basin where we're focused. And it's an area where we have unique skills that we've built up over the last several years, particularly in ISR mining. We are, I say this with confidence, the global leader in ISR mining in the Athabasca Basin. We have more knowledge and expertise there than Cameco or Orano or Kazatomprom or any of the other players would. It's a combination of taking a really special mining method and pairing it up with unique geology, and that's our box, right? So right now we're focused there. It's not to say that there aren't good jurisdictions out there, but for us, that's where we can deliver the most value, is ISR or Athabasca Basin.
Denison, key catalysts.
We've got quite a rich next, call it 1 to 2 years in catalysts. And it's a split. It's on one channel, it's all Wheeler River all the time. On the other channel, it's our portfolio of projects, and the portfolio assets are becoming very important because the market is certainly looking for additional sources of supply. I mean, utilities are very interested in Wheeler River, but what surprises me sometimes is how much interest we get in the other projects and when we could be producing from other assets. But for Wheeler River, look, everyone is waiting on a big update from us on the permitting timeline. We're several years into the environmental assessment process. That is the critical path on permitting. We submitted our draft EIS in October of 2022. We guided then 2 to 3 years to get through that process and to be in a position to construct. We are still on that timeline. Our objective generally is to make a final investment decision towards the middle of 2025. That would allow us, with about a 2-year construction timeline, to be in production in alignment with our guidance of end of 27, beginning of 28. So definitely permitting would be a major catalyst for us. We have been quiet, just sticking to our guidance on permitting. It has not changed, but we've not been out there, itemizing every little filing and form or this or that. So I think some people might get caught off guard by how far along we are. We are truly nearing completion of this federal EIS review, and we've already got support from the province on the provincial EIS. So that is something that we've been talking more about this year, but I'm always, I've certainly heard back that is not what people were expecting. And so hopefully, as we talk about it a little bit more, we converge sort of expectation with where we're at on that. And also at Wheeler, it's the engineering and design. So we announced at the end of the second quarter, we were 30% complete total engineering. That number has obviously progressed past that since then, and we'll be updating on that. It is ramping up so that we can be in a position to make the development decision by the middle of 25. We also have continuation of community agreement negotiations. We've announced 2 major Indigenous agreements on the project, potentially more to come. And project finance. I mean, we have an exceptionally strong balance sheet right now. We ended the second quarter of the year with around $400 million in cash and investments on the balance sheet. That compares to CapEx for Phoenix of around $400 million Canadian. So we're really well funded. But the market is also definitely interested, and we'd like to provide more guidance on how we'll fund the balance of our needs for the project and what we're doing with our physical uranium holdings. So that's the Wheeler channel. If I switch quickly over to the portfolio, we do have studies underway at 2 of our pipeline development projects. One is Midwest. This is a joint venture with Orano. We're a minority on this project, but we have been leading the study for evaluating Midwest as an ISR uranium mine. This follows on a concept study that was very successful that we've already completed, and a field test, which we carried out for the first time, an ISR field test at Midwest in the beginning of 2024. So we've got the ingredients there to put it in together into a PEA, and we're targeting that before the end of 2024. And also building on similar successful field tests at our Waterbury Lake project and the THT deposit. We're working towards completing a pre-feasibility study for that, which would allow us to declare additional reserves under 43-101. So that's a project that we own jointly with the Korean state-owned power company, KHNP. They run all the nuclear power plants in Korea, and they're Denison's largest shareholder. So we've got those 2 studies on the go. And then the last piece would be our exploration. We're working diligently on our own portfolio of projects, but we also have investments in others in the space, and recently announced a transaction with Foremost Clean Energy to take a package of our sort of non-core exploration projects that we weren't reasonably going to start working on in the next few years. Seed that company as an uranium explorer. We've got a large shareholding in the company now, and we've retained an interest in the project. So we'll have them deploy capital into those projects as well. So all 3 channels here: mining, development, exploration. They're all going hard right now.
The strategic importance of uranium in America.
Oh, look, I think the U.S. government's recognized over the past few years the importance of clean energy and certainly started putting money towards that goal of sustaining clean energy, typically at the cost of coal or any other type of energy source. And I think that the government, is now putting aside real money in order to facilitate the build out of nuclear. And right now, the government's focused on kind of the nuclear end of the value chain. We're actually at the beginning of that chain when it comes to uranium production. We know the money's starting to filter down. We've had discussions in the past with Department of Defense, Department of Energy, to seek funding potentially for the build out. No, I think that the government recognizes a need, and certainly will be looking to expand outside of existing facilities, but also look to fund the build out of other facilities, and hopefully be able to cut some of the red tape which hinders the build out. Hopefully shrinking that time frame from kind of 5 to 7 years, and hopefully somewhere about half of that. So I think government recognizes it. I think government understands the threat not only of suspending production or suspending import of material from Russia, but also understanding Russia's an independent actor and can certainly turn the spigot off itself. And we know Kazakhstan is also a place where a lot of material that used to come to North America is now flying eastward to China. Ukraine-Russia war, a lot of material used to flow through St. Petersburg. That's a bit more challenging today. So looking for land paths, which are much more challenging and time-consuming. So I think in terms of ease of sale, Kazakhstan's probably going to stay in Eurasia, and North American reactors will have to start looking elsewhere for supply. And I think the aim here is to make sure that domestic supply is sufficient to meet the needs of U.S. utilities.
Bipartisan support of nuclear power.
Oh, I think it's very significant. There are very few things that both parties agree on nowadays. I think back in 2017 when President Trump was in power, he was also involved in looking at the potential of adding tariffs to material coming in from overseas, and it's all kind of snowballed from then. And so I think that with the Democrats now embracing the idea of nuclear, clean power, the risk of climate change, all these things have kind of brought everybody to the table and said, we need to find a different way to deal with, an energy crisis potentially, right? And obviously the threat of Russia, that's also a bipartisan for the most part event, but also the knock-on effects of having, that war, potentially scupper, the supply chain of material coming from Asia. That's also another risk that I think both sides, can readily see. So I think the fact that ultimately the U.S. being able to depend on its own workers, depend on domestic supply, build up another class of workers, and improve the economy in some of the states where these facilities are, which tend to be states where not a lot of work is available. The socioeconomic challenges are pretty significant. So I think all these things combined, mean that nuclear is in the right place at the moment, and certainly the opportunity for domestic improvements, is there, and certainly the government's taking full advantage of that.
Uranium market stability without Russian exports.
I think there'll be a challenge in the near term. Certainly, I think that over time, I think it's one of the reasons why we're seeing build out of other parts of the value chain. Comes to enrichments or conversion, those types of things. Like anything, there'll be certainly some bottlenecks in the near term, but I think over a longer period of time, it'll be advantageous for the U.S. to have its own supply, within each part of the value chain.
U.S. uranium milling in demand. 2 of the 3 assets acquired.
There have been some transactions related to the conventional uranium assets, processing facilities in the U.S. very recently. That's 2 of the 3 that are in existence. Very important in terms of processing the material in order to turn it into kind of viable substances for the use in reactors. So the fact that there has been transactions, I think, points to the fact that the U.S. may be turning away from outside sources of uranium and certainly looking to become more of a domestic supplier because there's massive demand in the U.S. market. So I think it's hugely valuable to have processing, whether it's ISR or conventional, but the fact you've got existing infrastructure in place that you can fund, you can refurbish for much cheaper and a much quicker time period than try to build something from concept is advantageous. And that's why we're seeing this type of transaction taking place. Right now, if you look at all the licensed capacity that's been announced, amongst producers, ISR, conventional, you're looking at somewhere between 25 and 30 million pounds per year. Demand is closer to 50. So even with all the capacity running at maximum, it wouldn't meet current demand. So that speaks to the fact that there'll be more infrastructure required in the near term to sustain what we have in place today. If they're building more reactors in the U.S., however, you're going to need even more capacity. So I think that we're still at the early stages when it comes to processing facilities or processing capacity. I think there'll definitely need to be an even greater build out of that infrastructure.
Time and cost to build a mill from scratch versus refurbishment?
In terms of building out a new facility, we're talking concept to construction is probably somewhere between 5 and 7 years. You need to get a license in place. You need to find a place where you can build the mill, where you have to worry about NIMBYism. There's a lot of opposition depending on where you are when it comes to building some kind of facility like this. So you need to find a remote spot, but it does take some time. And I think if you're looking 5 to 7 years, this is a long time frame when the capacity is required in the near term. In terms of costs, if we're looking at a facility similar to the Shooting Canyon Mill, if you're to look to replace that, we're probably thinking somewhere between $200 to $250 million US to build out something with a capacity of, call it, 2-3 million pounds per year. If we're looking at ISR, it might be a little bit cheaper, but there's a sustaining cost, which is going to be higher. And usually those facilities tend to be smaller in nature. They'll produce as many pounds, but it's a significant investment in when it comes to building out facilities. But certainly, given the requirements and the needs in the U.S., I think there'll be certainly monies to fund it. The U.S. government's obviously getting involved in funding these types of facilities because they realize that dependence on Russia, Kazakhstan, Niger, other places, is a risky prospect.
Will more milling capacity be required?
Yeah, there'll be a need for even further processing. As I mentioned, current capacity, licensed capacity is roughly between 25 to 30 million pounds a year, 50 million pounds of demand today. More reactors being built in the U.S. will require more pounds. A lot of those pounds that are coming from overseas at the moment, that spigot may be turned off by Russia or Kazakhstan. Kazakhstan selling to China, pivoting completely away from North America. There's the risk there. So, I think there'll be significant capacity required in the U.S. And I think that's an interesting opportunity for those who are in the market.
Restocking cycle or sustainable demand growth?
On the demand side, we're now seeing Japan sort of bringing back its nuclear power. We're seeing nuclear power growth in Eastern Europe. Poland's a strong one, continued growth in the Czech Republic, Hungary. China's still building nuclear reactors like crazy, where we, see on the order of 6-7 new reactors almost on an annual basis now. And so growth is really strong there. The Middle East, obviously we saw the beginnings in the UAE. Now we're seeing Egypt and others sort of coming into the fold, Saudi Arabia looking at nuclear. So we're really seeing that take hold. And finally, I think nuclear is being recognized as sort of a green energy source. And I would say prior to the last few years, it wasn't quite, is recognized for its zero emissions capability and carbon reduction, credits there. So, I think that's become a big factor. And now, obviously, the push towards AI and, the necessary power there that companies like Microsoft, Alphabet will need for AI generation going forward, 24/7 baseload energy. So that's sort of a new twist. And now we're also seeing the push toward small modular reactors, from the standpoint of potentially being a little bit cheaper than obviously some of these large scale, 1,000 megawatt plus reactors that we have out there currently.
Has public opinion ever been this positive?
You know, obviously the early 2000s, there was a little bit of a push. You know, there was sort of, I know that at the time, the U.S., I can't remember, they came out with a program. They were looking at 10, 20 new reactors, I want to say by 2020. You know, that didn't really pan out. But this new push, I mean, it's definitely more comprehensive. It's more global. It's not just, you know, the U.S. It's other countries are involved. And I think people also finally realize that, you know, the capabilities of solar power and wind power are obviously somewhat limited, you know, in terms of, you know, if the wind's blowing, yeah, you're going to have wind power, but, you know, obviously it has its limitations. It's not sort of a 24/7, you know, on type of situation that you have with nuclear power reactors. And, you know, there's also natural gas, which is still quite promising. It's relatively cheap, but obviously, you know, with some of the cutoff from Europe, from Russia, you know, there's less natural gas going from Russia now to Europe, and some of U.S. natural gas is now flowing in that direction. So, you know, I think everyone getting to realize that nuclear power has a lot more benefits, and sort of obviously it's clean energy potential, but yeah, it's definitely more promising. I can't remember a time, I've been in the industry for well over 30 years, where I've seen such sort of a bullish outlook for nuclear power.
Inventory outlook and potential bottlenecks?
So there's limited capacity right now, really on the conversion side, that's really been driving prices quite a bit higher in that sector. You know, just a few years ago, you know, prices were in that $20 to $30 per kGU level. Now, you know, the spot price is upwards of $80 per kGU. So there's fear that there could potentially be a shortage of conversion capability if not enough Russian enriched uranium comes in, because then you would need to have more conversion capacity in the West to basically convert that material to then enrich that material. So that's where I would say the biggest bottleneck right now is in conversion. And there are really like three conversion plants. You've got Converdyne, which utilizes Honeywell's plant in Metropolis, Illinois. And then you've got Cameco, which their conversion plant. And then in France, you've got Comurex, which is owned by Orano. And so, you know, there's some thought that maybe Honeywell could expand in the near term. And there's another plant in the UK called Springfields that could potentially be retooled to come online. But both of those probably won't happen until the late 2020s, early 2030s. So, you know, we see a potential there for, you know, a shortage, you know, in the next, you know, few years if, you know, there's not enough conversion capacity to convert the amount of uranium needed to be enriched. And then on the enrichment side, you know, things are pretty tight right now. A lot of enrichers have gone to slightly higher operating tails, and when they do that, they need more uranium, but then they have less. They utilize less enrichment in doing that. But things are pretty tight there as well. I would say conversion's the tightest, and then enrichment, and then probably uranium thereafter.
America's role in uranium supply?
So it'll definitely have a role. I think a lot of U.S. utilities would like to buy U.S. uranium. I think historically, or going back several years, they stayed away from U.S. uranium because basically we had too much uranium, and they were going to buy from the lowest cost producer out there, which in many cases was, you know, the likes of a Kazatomprom or a Cameco. And so, now going forward, they realize there are fewer options, and U.S. uranium is a much less risky option for them. And uranium prices, where they're at now, spot, term price around that $80 level. It's certainly high enough to incentivize, quite a few U.S. uranium producers to push forward with some of their ISR projects and conventional projects going forward. So, I would expect in the next few years that we'll see continued growth in U.S. production, probably somewhere in between that 5 to as high as 10. I would say probably 5 to 7.5 million pound range would probably be more realistic. I do think going forward, if we continue to see the push on SMRs and the push to more high enriched uranium, you've seen the U.S. government come out and say, we want to see more of a domestic infrastructure in terms of supplying HEU into the market or high enriched uranium for a lot of those SMRs going forward. So, I certainly think that's also a factor. If the government comes out and buys more uranium for sort of a government stockpile, that could also help U.S. producers going forward. So I think, I would say, that 5 to 7.5 million pound range is that's about 10% of U.S. utility demand, maybe a little bit more than that. And I think that would sort of, be reasonable for the U.S. industry and given the resources that we have in this country.
Next up, you're going to hear about the value of diversified critical metals. We're going to hear from Terry Lynch, he's CEO of Power Nickel, and Marc Bishop Lafleche, he's CEO of Ecora Resources.
We have a lot of great insights in this segment. Terry will kick it off. He'll discuss topics including where we sit in the current commodity cycle, the significant value of polymetallic deposits, Nisk, high-grade polymetallic discovery, the Lion Zone, and exploratory drilling ahead. Marc, topics will include outlook among battery metals, Ecora's unique critical metals royalty model, uranium, NexGen Patterson Corridor East royalty, and catalysts ahead for the company. Where we currently sit in the commodity cycle?
So, we're actually in a pretty good commodity cycle right now. I would say if you look at it historically, probably top 75%. So it's actually in a pretty healthy area historically. It's not healthy from a miner perspective because it's not translated into values for miners, but commodity cycle's in a pretty healthy spot, and it's probably trending up. I think if you look at the the equity to commodity ratios, the equity market versus commodities, that divergence quite large, but which speaks more to how frothy the equity markets are versus necessarily any sort of opinion on the commodities. But one would think that divergence will converge. Historically, it always has, and so it's highly likely from a macro perspective that commodities are where you want to overweight over the next several years. Would be my guess.
Commodities versus commodity mining stocks.
So again, historically, commodities will tend to run first, and then the miners, and then typically it's the seniors, then intermediates, and the very last is the juniors and explorers. So that's, again, sort of playing out as we would expect. It's probably been more severe this cycle than ever. We've talked about that off screen. There's some other, countervailing issues with respect to the markets, but generally speaking, it's fairly traditional of what's happening where the commodities are actually turning. Seniors have done a nice little run here. Intermediates have had a pretty good run. You're starting to see consolidation, which you'd expect at this time in the market. So eventually they'll all realize, holy crap, I don't have any growth. I need to get some growth. I got to get some explorers, and that'll trigger the next boom in this market, and that's coming.
Commodity M&A cycle.
Yeah, you're starting to see it pick up now, right? So we've had almost every week there's a fairly significant acquisition, either in precious metals or in base metals. So I think that, and more acquisitions lead to more acquisitions because people have benchmarks, and now valuation parameters are set, percentages above moving averages, so now you've got your deal bookends are in place, and and so people are arguing less about what the deals are and whether or not they make sense or not. So I think you'll see that continue to pick up steam. So I think that's where we're heading, and then eventually what happens is the majors will realize that at some point they really got to add some tonnage, whether it be ounces in the ground if it's precious metals, or tonnage if it's base metals. So they're certainly coming to that, and you're starting to see that. When we were in Beaver Creek with you, we had as much interest from industry as we did from investors. Which just speaks to, hey, they're finally waking up to the fact that, hey, there's some companies out there that have made some amazing discoveries, and that's ultimately going to translate into something that the majors are interested in, and they're now starting to do their due diligence, which is sort of the process that they go through.
The significant value of polymetallic deposits.
Yeah, so let's talk about what does polymetallic mean. So people talk about ore bodies with metal credits, and that's one thing. But polymetallic means that in this case, like in a situation like Power Nickel is going to be one of our cornerstone revenue generators for sure. But in our case, it won't be the dominant one. So it won't be 50% of the ore body. It'll be probably somewhere around a third or something like that. So that's what makes it polymetallic is that your dominant revenue thing is less than 50%. So in our case, we'll probably be looking at almost an equal distribution between nickel, copper, and what we would call noble metals, which would be platinum, palladium, gold, and silver. So that's a pretty robust lineup for us. The reason why polymetallics are the world's richest mines, so better than gold, better than uranium, better than diamonds, polymetallics are the most valuable mines in the world. The only mine that's ever produced $1 trillion worth of in-situ value is Norilsk, obviously, and that's in Russia. They've been producing since the 50s, and they'll be producing until the 2050s, I'm sure. So it's just a monster deposit. Nothing's come close to that. But other examples of that would be Voisey's Bay, Xinhuan in China, Platte Reef in South Africa, where Robert Friedland's got his. So the reason why they're so attractive is you've got so many mineral contributions. So in Norilsk, they have 15 paying metals. Expectation at our deposit at Nisk is that we could have as many as 11. So all that contributes to your mining costs. So your mining costs will be very low relative to your revenue value. So, like for example, Nisk, which is a 4-letter word in most people's vocabulary these days, even though it is 6, Tom. But the thing that people get sort of freaked out about is obviously the Indonesian influence on the nickel market, and that's been profound. But still, nickel's sort of $7-8 a pound. Our lifting costs, we would forecast to be way less than half that, is our guess. So you're still making money. So in a soft nickel market, you're making money. On a great nickel market, you're making lots of money. So, I mean, that's the neat thing about polymetallics is they're naturally hedged. So not all of them are cycling up at the same time. Not all are cycling down at the same time. So from a return of investor capital, it's the best way to make money for investors. So that's why they're highly sought after, and they're super rare. And they can be super big. So it's a unique combination if you're lucky enough to find one, and that's what we're looking at right now.
Nickel market, North America versus Indonesia.
Sure. So we people think of nickel and they think it's like soybeans or oil or something like that, but it's not really. There's quite different markets for nickel if you're in Australia or Asia or Africa. Or North America, for that matter, and generally, it's a product of the demand for the product. So, in North America, because of the Inflation Reduction Act, the IRA Act, there's a big demand for nickel either made here, i.e., mined here, or processed here, because the North American vehicle manufacturers, if they want to provide a full-on credit to their consumers to buy the EVs, they have to have, generally speaking, a lot of nickel in their batteries. Okay, so that's the plus. The other thing that what's interesting about the North American market, I guess, is that, and it's a growing phenomenon worldwide, is technologically speaking, while nickel growth is happening because of electrification, that's not the sole reason why. I mean, stainless is the underbelly of nickel, so 60 to 70% of nickel is consumed for stainless steel, and stainless steel is basically urbanization. So as long as we're having more people in the world and they're living in cities, they're buying more fridges and stoves, pots and pans. That's stainless steel. So that's why it's other than COVID, 6% compound annual growth rate and keeps on steaming along. So it's a great sort of underbelly market. But this is where the Indonesian market generally has been focused, right? That's where it's going. Now, obviously, with the EVs, they've come up with some ways to make sort of nickel solutions that the Chinese battery makers have been using, but it's been at great ecological cost. So yeah, they're solving some problems there. They're creating more, and it's a troublesome issue for the Indonesians. And my heart goes out to them, because it's not like, hey, they just got laterites that's sitting on the top of these tropical islands, and it's not like they're trying to do the best they can for their country. I get that, but it's like, you get the positives of getting some nickel revenue, and that helps, but then you got killing a lot of stuff and poisoning your villagers, and I don't know what the net impact is not good. So that whole Indonesian thing is already rearing its ugly head. And so, I'm not sure what the resolution on that is, but it's probably going to be positive for the nickel market overall. And then, of course, you've got the growth of nickel in 3D printing and in the, unfortunately, in the armament. So missiles and bullets and stuff like that. So nickel powders, which is an area we're focusing on, is a tremendous growth market, going to 26% per annum. So prices there are, triple LME. So it's just staggering, and it's very tight market, and so we've been doing a feasibility study with CVMR, who's one of probably the world's largest private nickel refiner, and we'll have something out in that in the next month or so on our approach on that nickel powder market, and some very unique possibilities for power nickel, and how we can sort of get into that and make make a lot of money for our shareholders. So that's what we're excited about, and we think North American nickel is a completely different animal, and it's a 6-letter word, and we're happy to have it.
Nisk, high grade polymetallic discovery.
Yeah, I mean it's just crazy how good it's been, honestly, and I pinch myself, but I mean we're here. I'm here in Ottawa today with our exploration team. We've got a 3-day offsite that we're halfway through, and I'm more excited now than I've ever been, and I say to myself, I don't own enough of this. I own a boatload, but it's crazy. Yeah, I mean, our last hole that we announced was our best hole, hole 70, 32 meters of almost 7%, copper equivalent, and that's with the platinum and palladium numbers at pretty much the bottom of the cycle. You take that to the ordinary place where they're at, and we're at 10%. So it's like it's 7% going to get better in my view, and yeah, this thing's a beast. So we think this zone is growing much bigger than we originally thought, and we think that I think for every ton of this copper equivalent we're finding, there's probably at least 5 more tons of nickel sulfide underneath that we haven't found. So there's whatever growth we're having up top, it's also implying the growth of what was underneath. So this thing is going to be a beast, and yeah, I don't think any of us own enough of it.
Lion Zone and exploratory drilling ahead.
So yeah, so we've been going. It was funny. We drilled. We think it was a steeper plunge, and we drilled that, and it actually missed the core zone, but the halo zone was very productive and quite healthy, and we thought, well, that's a very good sign, because that expanded it quite a lot. And then, of course, we re-angled the drills and went further west, stepping out there, and bang, whapped into our biggest hole yet. So that's very encouraging. And we stepped out again further west. That's coming. I guess we got 2 more sets of assays coming over the next few weeks. So we're expecting more positive news there. I mean, we put that in our press release when we said we expanded the zone by 50%. We put 7 cores in there, and 4 of the 7 have been produced, and 4 of them are great, and the other 3 are to come. So we're still betting 100% on pretty pictures and great assays. So if one was a betting man, one would bet those other ones are going to be good too. But so it's continuing to grow. We don't really see any. We'll see. We're continuing to expand. At depth and along strike. So that's great news for a exploration company. So we're sort of keeping on going. The team is excited about what we see based on, because while we did a lot of expansionary drilling, we've also done a lot of research work to identify keys to success going forward on advancing the zone, both sort of looking for other land zones, which we believe there will be others for sure, and ultimately how to vector into this deeper nickel sulfide body, which we believe is there. So you're getting some great insights there, something we're really excited about. So we've got no shortage of really great targets, for our 30,000 meter fully funded program. So we're quite keen about what's going on next.
Outlook among battery metals.
So I'll answer the question slightly differently, if I may. and answer it in the context of the electrification trend as opposed to the narrow aspect of batteries. And in that context, number one is copper. It has to be, because ultimately copper is one of the most conductive elements. Of course, you could use aluminium, but ultimately copper is superior for a number of reasons. If we're talking about an electrification trend, how could we ignore the amongst most conductive elements that's available to us in scale to build our power grids? And I think more generally, when you look across the basket of all these commodities, if you take a 10-year view, it's all structurally quite positive. I think what you see is really stable, relatively stable demand growth trends. And on the other side of that, commodity supply, which, as we all know, can be difficult to bring to market. So then the question is probably, well, what's different over a 10-year, over a 5-year, over a 1 year, right? And if we start from the short term, and then today I would argue that when we look at our business anyways, and what we see in the market, today copper is really exciting. We think that lithium is really compelling, cobalt especially. The base metals, other base metals like zinc, for example, today offer some really interesting entry points. But ultimately, when we invest in royalties and streams, we're really doing it on a 20 and 30-year horizon. So what we're comparing is an expectation on 20 to 30 years versus entry point, and that's really a function of where we are today. And I think the other really important point to note when you answer the question, what's interesting in 1 year, 5 year, or 10-year view on these commodities, is that some of these commodities have really small markets. So let's talk about copper. Copper, call it 25 million tons a year. Nickel is around 2 and change. So you're already between nickel and copper, 10 times differential. And then if you scroll down to some of the other commodities like lithium, high purity manganese, cobalt, now you're talking markets that, well, maybe not lithium, but markets that are sub 1 million tons a year. And what does that mean? Well, I think when you see such rapid demand growth, trying to match that with supply responses in the mining sector, which are really choppy, bringing a mine online takes a lot of time. And you can't really bring a mine online in incremental units to perfectly time it with supply. So I also think in the next 10 years, especially for some of the commodities that are growing from relatively smaller basket sizes or total market sizes, we're likely to see commodity price cycles of greater frequency, but also of greater amplitude in the price curves. And a good example is lithium, right? We've seen already in the past, 6, 7 years, maybe 8, 2 price cycles and some really big swings in lithium prices themselves. Behind that, that's probably more of in many ways, demand is a factor, of course, but a lot of that is supply driven. So that's really interesting to dig in on any specific commodity when one's looking at the entry point and the horizon.
Ecora's unique critical metals royalty model?
Yeah, in a nutshell, Ecora, it's pretty simple to understand. First and foremost, we're a royalty company. And as a royalty company, we don't own the underlying mines, but we provide financing to those who own the mines, or we acquire existing royalties. A royalty entitles Ecora to a percentage of the income generated when minerals are extracted from the royalty interest area. And when we receive our royalties, we receive them by virtue of the sales price of the mineral. So we don't have exposure as a royalty company to the risks and rewards of the extraction costs as well as the capital costs from actually operating the mine. With our portfolio of royalties today, our portfolio is weighed towards assets that are in production, over around 95% are in OECD and Brazil as a jurisdiction. Very heavily weighed towards operations that are either producing or expected to produce at the low end of industry cost curves, and thus resilient operations or expected to be resilient operations that can generate strong free cash flows through price cycles. And from a commodity perspective, we've targeted a portfolio that's very heavily weighed towards base metals, but in particular copper. And copper is really the core of our growth story over the next 5 years. Today, copper is the largest component of our NAV, but is not yet reflected in as the largest contributor to our earnings. If you fast forward say in the next 5 years, copper would be expected to be the number one commodity by NAV, but also by revenue.
Which royalty in the portfolio could surprise to the upside?
If I had to pick one, though, and you're really forcing my hand here, I'd probably say I'd go on the one that will be seen the most immediately, and that's Voisey's Bay. At Voisey's, we have a cobalt stream, and this is an asset and a royalty that can just do so much more than it has. This mine is now really has entered a ramp up phase that has been delayed, although is now at a ramp up phase where we're expecting to see some really sizable increases in volumes under our stream. We'll probably see that as soon as this quarter versus H1, but that should carry through into next year and the year after. This is an asset which, in terms of volume subject to our stream, and you compare it to 2023 to full production by the end of 2026, is almost a 400% increase. So that's one that is happening. It's here, it's now, and should the financial benefit should be felt in our income statement almost immediately, with increasing magnitude as time rolls on. And furthermore, on the price side, cobalt markets have been challenging of late. The cobalt is one of those commodities that I mentioned earlier, small market, and therefore is disproportionately impacted by supply additions relative to, in sort of absolute sense of volumes relative to other larger commodity markets. We've seen units come to the market in the last 12 to 18 months. When we look at what the industry is forecasting for new cobalt additions, nothing of the sort of order of magnitude that's comparable that came in recently. So the outlook for cobalt as well, we're certainly not calling the bottom today or calling a straight line upwards, but one of the keys to natural resource investing has, and others will be, probably entry points. And arguably, if one is to get cobalt exposure, now's a really good time.
Uranium, NexGen Patterson Corridor East royalty?
Yeah, well, 12 months ago, most people didn't even know we had a royalty covering the Patterson Corridor area of some of NexGen's properties. And until 12 months ago, if NexGen knew, the market certainly didn't. There really wasn't much in that area. In March of this year, we announced with our full year results that NexGen had struck some really spectacular drill holes within the Ecora royalty area. And ultimately, drill holes are drill holes. There's a lot of risk associated with proving out that resource and eventually taking it to development. But with some benefit of further drilling, in the past 6 months, we've seen a deposit of scale and magnitude that's comparable at the similar sort of stage of exploration work to NexGen's Arrow deposit. So having that within a royalty area, Ecora's royalty area, is really encouraging for the longer term, and actually highlights, we don't have a huge uranium exposure, but it's really interesting in our view. In terms of production, we have exposure to the Cigar Lake operation by a toll milling agreement for material that passes through the McLean Lake Mill. We have a second producing uranium royalty in Australia over a mine called the 4 Mile Mine. And then on a longer dated basis, we have this royalty over what could be one of the most substantial uranium discoveries the last 10, 20 years maybe. So it's certainly one to watch. It's early days, of course, and not without its risk, but has the potential to be quite sizable in time.
Catalysts ahead for Ecora.
2025 through 2030 is going to be a period of substantial organic growth, and we've been patiently waiting through 23 and through 24 to get here. But our portfolio that we've assembled now just delivers a lot over the next 5 years. And first and foremost, I mentioned already the ramp up of Voisey's Bay that is going to be felt in the very short term, with that asset moving from a mix of the material mined above ground to really higher grade material underground, which is great for us. That should see our cobalt deliveries increase significantly over the next 2 years. And the next biggest thing to watch over the next 6 months, 6 to 12 months, will be number one, the financing project, the financing process that Capstone Copper is undertaking with respect to the Santo Domingo project. Earlier this year, Santo Domingo The merits and the quality of that project were really highlighted by an updated feasibility study that was released by Capstone Copper, and based on life of mine cost estimates, would project that project to be amongst the lowest cost, fully permitted greenfield copper projects in the world. So the first step, as I mentioned, would be potentially exploring bringing on a strategic partner on the equity side, and then thereafter a potential final investment decision and start as construction, which had previously been targeted by Capstone as early as next year. We anticipate at Mantos Blancos a step up in volumes in the short term as production volumes step towards phase one capacity levels. And then beyond that, there's a potential to further grow volumes through a phase two expansion. We have a royalty over a brownfield copper project in Nifty, which is now near the end of a fundraising required to restart SXEW operations and basically start extracting copper from some leach in a very low capex sort of way. But thereafter, the really interesting thing about Nifty is the possibility to restart a brownfield copper concentrator and deliver currently targeted CU copper in concentrates of 35,000 tons a year, which is a great operation, great size, 17 years, could be quite meaningful to Ecora, and that restart is of course targeted in the near term. And then last, but certainly not least, is a royalty we acquired recently over the Palabora project, which is amongst the world's best quality, if not the best, rare earth development projects outside of China. We acquired that transaction actually completed last week, and in the upcoming months, we anticipate seeing an updated DFS, and then thereafter, the company will put together its financing program, financing package to take the project towards first production. So quite a lot in all those royalties, but I'll probably just leave it there. There's a lot more detail on all of that available on our website, but of course on the website of our mining partners as well.
All right, next up, Lithium is the bottom in. You're going to hear from Rob Weir. He's VP of Corporate Development at Lithium Royalty Corp.
Some of the key topics that Rob will cover will include lithium, signs the market is close to a bottom, structural EV demand, will lithium remain a key component in battery chemistry, M&A, Rio Tinto and Arcadium Lithium, and applying the royalty model to lithium. Lithium, signs the market is close to a bottom.
I think we are. We've seen some pretty large assets in China, notably CATL's lepidolite mine, come offline this month. That's around 5% of global supply. You see numerous project deferrals, delays in the Western world, and you're seeing groups like the CME launch a spodumene futures contract towards the end of October. So we're 22 months into this bear market, and we think we're much closer to the end than we are the beginning.
Structural EV demand.
EV sales have been very strong. BYD alone is selling 400,000 electric vehicles a month. GM's come out with a very low priced Equinox SUV. Those models are attracting attention. Sales were up 49% quarter over quarter. You're coming off a small base, but you can't ignore those type of growth trajectories. So, very misinformed in terms of what's actually happening. If you have to look outside of the traditional North American-based OEMs, they have all kinds of problems domestically in China. But there's a lot of cheap electric vehicles out there now. You've got charging times that are much faster. You've got a lot more locations in terms of chargers. So that range anxiety is becoming less and less of a feature.
EVs, China's leading the way.
Yeah, pollution was a big externality there, and I think that tends to equal civil unrest. And while they're not perfect, they've invested very, very heavily in their conversion capacity. They've been very innovative in the types of vehicles that they've produced, to the point where Chinese consumers prefer the domestic brands, which was never the case historically. So in August, you would have had 1.5 million electric vehicles sold, and 2/3 of those would have been domestically in China. And they've got a lot of excess capacity, and now they're trying to export to other geographies. And the reality is, I think consumers are very happy to drive those vehicles.
Will lithium remain a key component in battery chemistry?
Absolutely. It's the lightest element in the periodic table. It's the best charge carrier. It has the lowest risk of obsolescence. NMC batteries I don't want to say on the way out, but LFP's definitely been the focus. So less nickel, less cobalt, and lithium's here to stay. So continued EV penetration into the mobility sector, and then you add in ESS, and I think the consensus models are out the window. Demand's maybe growing north of 100% this year. So, you have to have the batteries there to store the wind and solar and have that power available at peak hours.
M&A, Rio Tinto and Arcadium Lithium.
I think first and foremost, it brings some confidence and stability to the sector. We've been mired in a 22-month price slump. And obviously Rio's resume needs no introduction. So, the best hard rock miner in the world, Pilbara, just paid a 67% premium for Latin resources in Brazil. So I think you're seeing very large pools of capital, very sophisticated investors trying to take advantage of this price weakness and position themselves for the next 20 years. And these are the first two transactions we've seen. I don't think it'll be limited to that. This deal hasn't been formally announced. Both companies have press released that there's a discussion happening in London this week, so we'll have to wait and see the final outcome. But I think Rio is very good news for the sector overall.
Region and deposit focus.
So from 2017 to today, we focused on the ABCs of hard rock. That's Australia, Brazil, and Canada. And really what we've looked for are high grade, hard rock, low capex, low technical complexity in safe jurisdictions. And so our portfolio is littered with assets that meet that description. Yeah, so Winsome's a great example. They've really accelerated their business plan by buying the Renard mine and related infrastructure. They signed an option agreement to buy those assets for about $54 million. Stornoway, unfortunately, had gone bankrupt due to rough diamond pricing, and they'd spent $900 million. It's a DMS plant. Pretty much everything is there for them. So that saves them hundreds of millions of dollars and really accelerates their business plan.
Applying the royalty model to lithium.
Yeah, as you alluded to, it's a well understood model, specifically in Canada with the likes of Franco and Wheaton. And we haven't reinvented the wheel here. We've applied those same best practices just to a different extraction industry. I think we've got about US $140 million of invested capital in the portfolio from inception. So I think the bigger thing to focus on is underwriting good assets using conservative assumptions and having really quality management teams there, especially when you go through a protracted bear market like we've been in. So I said that model's well understood, and we haven't done anything different than those companies, just a different commodity.
Catalysts ahead.
Yeah, we're going to be pretty active here in the fall. There's a whole bunch of different conferences: Red Cloud, TD, Citi, Scotia. We just had two big investor days on the 19th and 24th of September for actually Arcadium and Sigma. Arcadium's up 64% since then. Sigma's up 16%. And I think really the takeaway there was both companies were able to demonstrate very robust organic growth that's fully funded. So, when the commodity prices are out of favor, being able to do it on balance sheet, I think is a huge competitive advantage.
All right, next we have to talk about copper. It's one of the best performing commodities of the year. We're going to talk about the robust demand and tight supply. You're going to hear from Aurora Davidson. She's CEO of Amerigo Resources, a producer, and Christian Easterday. He's CEO of Hot Chili, a developer.
Key topics in this segment include Chile's importance in global copper production, China's strategic domination in EVs and renewables, driver of Costa Fuego's significant resource growth, importance of water rights in mining, copper prices high enough to incentivize exploration, an underappreciated source of demand, importance of capital return in mining, Amerigo, the copper utility model explained. The key drivers of elongated development cycles in copper.
Primarily, this is regulatory creep at its best. But this is not just across the copper sector, it's across most of the commodities. When we're talking about developing, projects, these timelines have been creeping And, hot chili is a great example where we have lived every year of the really long permitting timeframes it takes to secure critical infrastructure accesses such as water in Chile.
Exploration budget still tight?
I think you've hit the nail on the head. Higher incentivization prices on a higher copper price environment, attracting venture capital back in is what the copper sector desperately needs. It's a very strange world when you have copper at near record highs again, and yet we're seeing this large pullback in exploration being applied to discover new resources for the world, which the world desperately needs.
Chile's importance in global copper production?
Yeah, look, the numbers on Chile's significant contribution to the global copper sector, still number one and likely to be number one for some time. We're seeing growth of production in Peru, no doubt, and also in some of the developing countries, such as the copper coming out of Africa. But I believe that, if you look at the lineup of the pipeline of new major developments, you're probably still looking at around 40-45% of that contribution coming from the Andean belt, and the lion's share of that is coming out of Chile.
China's strategic domination in EVs and renewables?
Yeah, look, it's very forward-looking, isn't it, Thomas, to have taken really what was being driven from the West and now adopted by China, a rapid domination of electrical vehicle market, which, as I've probably said to you, is probably going to drive Western countries towards protectionism, tariffing to protect their domestic markets for that. But I was recently just looking at the research put out by BMO, and one of the many graphs that caught my eye, but certainly one in relation to what we're discussing, was China's uptake of renewable energy. It is so far ahead of where renewable energy uptake is in the West, and it is certainly leading the world in that. And that's really establishing them probably first in line towards, in the future, energy independence through renewables being a very large component of the new energy mix.
Drivers of Costa Fuego's significant resource growth?
Yeah, well, you pointed out a very critical part of our story. There was a hot chili version 1 with our original product Aurora discovery, some 250 million tons on the coast. But it was that decision and that really transformational event, the acquisition of Cortadera in 2019, and a rapid increase in our resource base, almost quadrupling it to 1 billion tons with the 700 million ton addition there. But that's not finished, as you said, Scott. We're sitting here with the largest copper resource on the ASX outside of the major, and certainly well entrenched within the top 10 globally, as you said. But the continued consolidation of Costa Fuego, this is a project that's not done on that front yet. We imagine this project will get larger.
Importance of water rights in mining?
Look, water is one of those unsung heroes of the mining sector, but the reality is without water you don't have a mine, and in our case, without a mine, there's no water for us and our surrounding area. So, uniquely through this very systematic approach to developing what will be one of 5 100,000 ton per annum large scale projects coming from outside of the majors in the coming years. That time frame to get permitting, one of the major strategic items that we secured was our water rights, the right to supply salt water to Costa Fuego. And that is now being advanced into our new company, Wasco Water, where we're now actively looking at the value of those water rights as a potential major contributor to the funding of Costa Fuego.
Hot chili catalysts ahead?
Yeah, look, just rounding out the last question, obviously the context there is water is critical, and water in the Atacama is even more so critical. You're not allowed to take water out of the ground in the Atacama, and this is holding a very, very large amount of new developed projects in the copper space in the world. So hot chili having the only maritime concession in the Wasco region puts us at a significant strategic advantage to supply our project with water. so it can be developed. But not only that, but potentially supply an entire region and the Wasco Valley region, their water requirements. So, the two most key activities for the company at the moment, where our focus is the completion of our pre-feasibility on this very large-scale copper development. That is on track with most of the work streams, or all of the work streams rather, due to be complete at the end of this calendar year. And then in parallel with that, we're also completing a pre-feasibility equivalent on Wasco Water and what that water business might represent. So two key pre-feasibilities coming to the market not very far away. And then on top of that, I imagine that most of the preparation that Hot Chili is also doing will allow us to be on track to submit our final permit application, our all-important environmental impact assessment, 10 years in the making. And that marks really a point where a time clock begins and is the period where we can complete our bankable while we're waiting for the final permit approval to develop this major asset.
Understanding the copper shortage.
The data point that I like the most, referring to your question here, is the concept of installed copper per person. And when you think about it, think about copper not being a consumable. It's not like oil. When you think about copper, you should think about the amount of long-term copper that all of us have installed around us to lead our modern lives. So we have a bunch of copper installed in our houses, in our vehicles, in the infrastructure that we use, in the devices that we carry around with us all day long. So there's an amount of copper associated with how we lead our lives, okay? And that is tied up to the development stage in a given country. So the more developed, the higher GDP a country has, the more installed copper per person we have. So let's look at China, because China is the world's biggest copper consumer. Where are they now? They are consuming around 260, or they have an amount of installed copper of around 260 tons per person. But they don't want to stay there. They want to continue developing. The central government in China does not want to stagnate economic development. In China, they want to continue growing. So as they continue to grow their GDP, they will need to grow the amount of installed copper that they have. And the target is, or the estimates are, that they're going to be growing from the 260 tons that they have right now per person to 360 tons in the next 10 years or so. In doing so, they will continue to consume a lot of copper. They will continue consuming around 15 million tons of copper per year, which is what they have been consuming, for example, in 2023. Now, when you talk about installed copper per person, that metric usually considers traditional copper uses. It doesn't yet factor in energy transition copper, digital demand for copper, which is something that's also becoming more and more noticeable. So just think about that jump from being at 260 tons to going to 360 tons for the Chinese, okay? That's huge. But the really interesting point here is when you look at India. And India has to be looked at when looking at the copper market because they have the same amount of people that China has. They have exactly the same population, 1.4 billion, each of them. And India right now is estimated to have an installed copper capacity of 15 tons per person, 15. So we talk India at 15, China at 260, China trying to get to 360. So can you see the gap between where India is now and where India could be? India has doubled their copper consumption in the last 2 years, doubled their copper consumption. So if this trend continues in India, we may have the same, we may see the same huge demand that we saw in China in the decade of the 2000s coming from India, or even bigger than that, just looking at this data point.
Copper price is high enough to incentivize exploration.
Currently this year, averaging just above $9,100 per ton on the LME as an average copper price. And I think when you look at copper prices, you have to look at an average, whether it's a yearly, average, quarterly, but it's not the day-by-day price. You never make a decision based on today's price. You have to look at an average. And the analysts, depending on who you read or who you want to talk to, they're talking about an incentive price of between 11,000 and 15,000 per ton. So there's a big gap between where we are and what that incentive price is purported to be. Depending on the numbers that I just gave you, it could be 20%. We're either 20% away from that incentive price, or we're 65 away from that incentive price. So we're not there. But in reality, I think the real challenge here is that it's not about the incentive price, because if suddenly you have the incentive price tomorrow, investment decisions are not going to happen immediately. And you have a myriad of other problems within the industry. We're just discussing in some other forums the lead time that it takes to move a project from discovery to production, 16 years. So yeah, you have incentive price, and then what? And then you wait 16 years to move your current project where you've already done a bunch of work all the way to production. With existing mines, expansions, yes, because you have incentive price, but you're also facing declining grades. So you may be expanding to maintain production. You're not going to be expanding necessarily to grow production. So if you put it all together, we are not where the incentive price needs to be, but also the incentive price will not be the magic pill that suddenly puts all the copper that's needed available to the world.
An underappreciated source of demand?
Everybody in the last years have been talking about the new wave of demand coming from the energy transition. We all have heard the stories and the catchphrases such as copper is the new oil. That all comes from the amount of copper that's going to be required to do the energy transition. But there is also another source of demand which has just become more noticeable, which is digital demand. And some people just say AI, it's AI. Well, AI is just part of it, but it's not all of it. When you're talking about digital demand, you have 5G, you have blockchain, you have AI, you have the Internet of Things. Everything that we use now has wire connectivity. Every device or electric toothbrush has connectivity, and you can download your data and get some feedback on it. So it's just a big source of copper demand. It's estimated to going to grow sixfold in the next years. Right now, digital demand is around 1% of global copper demand, expected to be 6% in the near future. So it's a huge source of additional demand.
Importance of capital return in mining.
When we're talking at Amerigo, we have been doing this business as the owners of this facility in Chile for 20 years, more than 20 years now. And we have reached our production goals. So we don't need any additional growth capital. And we're a very profitable organization. And that surplus cash basically can be directed to being returned to shareholders. So 3 years ago, we rolled out a capital return strategy. It consists of dividends, quarterly dividends, performance dividends, and share buybacks. And when you put them all together, they are providing our shareholders with a significant growth. It's not a production growth. It's a growth on your personal invested capital. We have been very active in this modality of returning capital to shareholders. In the last 3 years, we have returned $73 million US to shareholders. So it has changed who we are as a company. It has created a significant differentiation between Amerigo and other copper producers.
Amerigo, the copper utility model, explain.
We have a very simple business model. We are a copper producer without a copper mine. We produce all of our copper from processing tailings, which is waste material from the mining process. In our case, we're fortunate to have a long-term relationship with the world's biggest copper mine, Codelco's El Teniente mine, to process all of their tailings, their current tailings, and their historical tailings. So our business model essentially is to produce copper from waste material, to pay a royalty to El Teniente for letting us work with their tailings and recover that additional copper from their tailings, produce a copper concentrate and sell that copper concentrate at market prices. So we have the full exposure to market prices on copper, which is a huge thing to have these days, without a lot of the mining risks. That's, in a nutshell, our unique, simple, and very easy to digest business model.
That was a fantastic download on some of the most critical energy commodities in the industry, from copper, lithium, uranium, to diversified critical metals. Thank you to all the great speakers. We're going to end off the conference with a fantastic overview from Bid-Ask ETF research. We're looking, uranium ETFs are very important. That becomes like a starting point for a lot of investors. And there really hasn't been a critical analysis of this asset class. Scott, you want to talk a bit more about what we're going to look at?
Yeah, so Bid-Ask has done some unique analysis on the public side of investing in uranium stocks. If you want diversified exposure through ETFs, there's 4 or 5 out there, and there's some similarities, but more importantly, there's lots of differences. So we've done analysis looking at the valuation on $1 per pound of each fund. This is analysis we haven't seen anywhere else, and a lot more. So we're going to dig into the details right now.
All right, for those who don't know, Bid-Ask ETF Strategy and Research, which was launched in August of this year, is here to pinpoint the right strategies and exposures in the $3 trillion ETF industry. Now, this was an area that we really were focused on because what we found was that there wasn't a lot of really good in-depth research looking at the different sectors, different areas of exposure, the different specialties. There wasn't really in-depth work looking at how these strategies compared to each other. Now, this is really important because there's been a real sea change that's happened in the investment landscape. We've gone from a world of actively dominated investment strategies to one of passive. And just late last year, there was a watershed moment where passive ETFs have now overtaken, passive strategies have overtaken active, which is a massive sea change. And a product like Bid-Ask is here to help you navigate and understand what are the nuances that are in these passive ETFs. Now, well, our first piece in August was about large cap tech passive ETFs and the differences among them. And it's not small and not trivial. The difference in performance was as much as 20% among these ETFs and underperforming the index market cap weighted benchmark. Scott, maybe you just want to give a highlight of that piece, because that was a really important piece. And on the back of it, one of the providers, a couple months later, changed their methodology. Scott, you want to just give the Coles notes on that? We're going to talk about uranium ETFs, but we just really want to highlight the work that's being done here. And if you want to go check it out, it's Bid-Ask, bid-ask.io. But Scott, talk about the tech piece we put out in August, because that was really highlighted one of the challenges that investors aren't really aware of. They think, oh, I'm just going to put money into a tech ETF, and that's just going to have tech stocks, right? By market cap weight. But that's not necessarily the case, is it?
So there's a lot of details in the article. I'd recommend reading it. But the long and short of it is that there's an ETF that has, tens of billions of dollars of technology stocks in it, but it has an arbitrary rule that it follows. And that caused it to move more than 10% of the portfolio out of Apple and into NVIDIA in one day. So that's a big move. Obviously, that has performance implications. And we've seen how that's played out as we've been tracking that. So I'd recommend you read that. These are big funds with lots of investor money in them. And they may be doing things that you're not aware of. So that's where Bid-Ask comes in.
Yeah. And I think, I think one of the taglines we had in the piece, which was great, cheap comes at a cost, right? And in this case, right? And so investors right now in the world of ETF investing, in passive investing, Scott, the first thing they think about is how much is it costing? And they just think the MER. And this particular ETF had an 8 basis point MER. Okay, it's cheap, right? But it was underperforming the index by 20% because of these rules that Scott has alluded to. And so, this is something that's not talked about. It doesn't get a lot of airplay because the industry itself, the ETF industry, is conflicted. They're not going to try to go against BlackRock, Vanguard. Like that's not something they want to do. That's why Bid-Ask is here to highlight some of these challenges. Scott, now we've just put out a piece on uranium. You want to talk about that?
Yeah, so I'm going to give you guys the quick download. As usual, there's lots of extra charts and analysis in the piece, so I would recommend reading the whole thing. But I'm going to take you through three different differences in these funds. So there's 4 funds out there. They have about $7.5 billion in uranium. One stands tall, Ura, which most people probably would be familiar with in the uranium space. It has 60% of the assets, but the exposures are very different between all of these. And so the number one chart I want to show you is fund exposure by subsector. So do you want exposure to the miners? Do you want exposure to the industrial, the guys building the nuclear facilities? Or what about the utilities themselves that run the nuclear facilities? So you might think they're all the same, but you have Ura, which is about 75% in the miners themselves. The rest is in utilities, and they actually bizarrely own some lithium and battery metals miners, which you might not have known that digging in. And then NLR is another ETF that's about 250 million. That one is very heavy into utilities, and I'll get more into the valuation aspect. So you should know that the URNJ ETF, URNM, 100% miners, but big differences in valuation and whether they own large or small cap. Then these other guys have weightings to the heavy industrial builders and the nuclear facilities, the guys that run them. So just keep that in mind. And then the next piece is on the valuation of the funds. So we went through and looked at the current enterprise value per pound of each mining company, and then you weight that by how they're owned in the fund. So keep in mind, this valuation is just looking at the miners themselves. So if you own Constellation Energy or some nuke, a utility, that's not what this is looking at. So this is just the mining aspect. What funds are you paying up for? What funds are you getting a discount? As expected, and as you would hope, the junior miners ETF is the cheapest on an EV per resource. These are the junior guys. They're not getting that uplift. The market still is pretty consistent, where the larger the market cap, the higher the EV per resource, the bigger the company. There haven't been any really outliers or opportunities in this market that may come. But then if you look at Ura is the most expensive, and that's because they own those larger cap mining names. So that makes sense. But there's a wrinkle here. So you see NLR is cheaper than Ura on an EV per resource. But remember, that only looks at the miners, and NLR owns a lot of utilities as well. And so this is where, if you look at the valuation on utilities, we have a chart looking at the PE ratios, some of the big ones. And NLR owns more than 10% of Constellation. Just look at Constellation. It's gone from 17 times forward PE beginning of the year. It's already all the way up to 30. And we've looked at utilities for a long time, and so these valuations are generally stretched across the entire industry. So if you're looking at on the EV per resource for the miners, it looks expensive versus a junior. But then you have that you're paying up, potentially paying too much. That's to be seen. But the valuations are definitely higher than historically across the utilities sector. So that's something to keep in mind. As I said, these are as you can hopefully see, there's lots of big differences between these funds and exposure differences too. You're not generally just getting mining if that's what you really want. We have a lot more breakdowns of these 4 different funds. So I'd recommend checking it out at bid-ask.io.
Yeah. So great overview, Scott. And I would stress, right? When someone says nuclear, right, like it can be interpreted a multitude of different ways. But ultimately, an investor wants leverage, right? They want leverage to the trend, right? And having covered utilities for a very long time, knowing what a utility, how a utility is how a utility makes money, it's through their rate base and the return on that rate base. It's you see these stocks go parabolic, and you realize, wait a minute, your rate base does not go parabolic. It's a linear function, right? And that's very different, right? And some of these stocks are getting played for AI, et cetera. But that's very different than the margin enhancement that you get from a technology company, which, Scott, your margin improvement can be absolutely parabolic, right? Versus, say, a Constellation. Very different profit profiles for each of those companies.
Yeah, so it looks like the market is getting very excited about the potential of AI on energy demand and what that could mean to these utilities. But as Tom is saying, the utility business model is old. It works the same way no matter what. just because there's more demand, it doesn't mean they're going to get a margin uplift. It's a regulated business. It works how it's going to work.
Exactly, right? And so on all of these pieces, we're just trying to put it all in front of you, right? You want leverage to the trend, of course, but that's what bid-ask is there to provide you, like a real look through in terms of how these ETFs perform. The nice thing about it is now we have it captured in the database and how we're looking at it. You'll get that on a regular basis. So if you are a uranium-focused investor, if you are a nuclear-focused investor, just across the board, and you're looking at these ETFs, please do follow bid-ask because they will continue to provide you the updates as these funds perform. And so we'll keep you guys posted. Guys, want to thank you very much, Scott. And again, this is I think we've wrapped up the conference.
That's right.
Thank you for joining the Grizzle Uranium Battery Metals Conference.
Now, this wouldn't have been possible without our sponsors. So once again, we have to thank Denison Mines, a key North American uranium supplier now and in the future. Power Nickel, North America's most promising polymetallic discovery. Ecora Resources, offering a diversified critical metals royalty portfolio with dividend yield on top. Hot Chili, developing one of the world's largest copper projects. And Bid-Ask Newsletter, deep dive analysis you won't find anywhere else on the $3 trillion ETF industry. Visit bid-ask.io to learn more.